Millions of Americans wake up every morning in a country that promises prosperity but delivers panic. A nation with a $28 trillion economy, yet most families can't survive a $500 emergency. Groceries rise faster than paychecks. Rents devour half of a worker's income. Credit card interest crosses 22% while savings accounts sit at zero. Parents skip meals so their children can eat. Workers take double shifts just to fall further behind. And the fear isn't temporary. It's becoming normal. This is the new America where people simply can't afford to live in the country they're working to survive. America is entering an era where financial stability is no longer the norm, but a statistical rarity. The world's richest country now sits on a $38 trillion federal debt, and households collectively carry over $1 trillion in credit card balances, creating a nationwide fragility that no generation has experienced at this scale. The staggering part is not the debt itself, but what it reveals. Most Americans are surviving on razor-thin margins, with no cushion between them and financial collapse. Nearly 63% of workers cannot cover a $500 emergency, exposing a system where one broken appliance, one medical bill, or one tire blowout can force a family into debt that accumulates interest at 22% to 33% APR. What used to be minor inconveniences have now become life-altering setbacks because wages have not kept pace with the rising cost of basic survival. Gas prices fluctuate unpredictably. Grocery bills have risen by double-digit percentages. Insurance premiums hit new highs. When everything costs more but paychecks barely move, fragility becomes the default condition. This fragility is not only financial, it is emotional. Constant uncertainty erodes confidence, increases anxiety, and fuels a silent despair. When more than half of households with $100,000 incomes still live paycheck to paycheck, it proves this is not a poor people problem. This is a structural economic breakdown affecting every income group except the wealthiest. The core issue is the widening gap between what it costs to live and what Americans earn. Essential expenses such as housing, transportation, and healthcare rise faster than wages every single year. Even full-time workers face unavoidable deficits. Small emergencies escalate into long-term debt, and long-term debt triggers higher monthly obligations that suffocate any chance of building savings. As this pressure grows, Americans increasingly rely on credit to bridge the gap, not because of irresponsibility, but because the math simply doesn't work anymore. This is why credit card balances are at historic highs, and delinquencies are rising across every bank. The fragility is accelerating, not stabilizing. This financial stress merges directly into the next crisis: the true cost of being poor in America. Because when a nation's economic foundation pushes millions to the edge, it doesn't just hurt their wallets, it multiplies the cost of survival itself. Poverty in America is not just a lack of income. It is a financial penalty system that charges the highest prices to the people with the least resources. When a country with a $38 trillion national debt still forces millions to survive on margins thinner than a single missed paycheck, the consequences become brutally expensive. Poverty is not cheap. Poverty is a multiplier of costs. Every essential service extracts a heavier toll from low-income households. Utilities in poorer zip codes often carry higher fees. Car insurance premiums rise simply because of the neighborhood someone lives in. Rent consumes more than 40% to 60% of income in many cities, forcing families to pay far more for smaller, older units. Even basic banking penalizes the poor. Overdraft fees, minimum balance penalties, and high-interest loans function as traps that wealthier Americans rarely encounter. Healthcare is where this penalty becomes devastating. A single emergency room visit without insurance can cost $2,000 to $5,000, and even minor medical issues can turn into medical debt that lingers for years. Poor families postpone care because they cannot afford it, allowing conditions to worsen and costs to balloon. This is why economic hardship directly links to shorter life expectancy, higher stress disorders, and chronic illness. Poverty punishes the body as much as the wallet. The federal government spends $665 billion every year on economic security programs, yet families still fall deeper into instability because assistance rarely covers modern costs. Feeding a household has become a monthly fight as grocery bills surge, with many Americans spending $100 on just a handful of items. Households forced onto credit to cover these essentials face interest rates exceeding 22%, turning temporary shortages into long-term debt spirals. This economic environment traps families in a perpetual cycle. When you can't afford preventative maintenance, a dentist visit, new tires, a safer apartment, the consequences always cost more later. A skipped oil change leads to a $2,000 repair. A minor health issue becomes a major medical bill. A rising rent forces yet another expensive move. The financial pressure described earlier now merges into something far worse: the widening inequality gap. Because the poor aren't just paying more, they're paying disproportionately more in a system where upward mobility becomes mathematically impossible as economic distances grow wider. America has entered a stage where wealth is no longer separated by a gap. It is separated by a canyon. The distance between the top and the bottom has widened so dramatically that the economic ladder millions once relied on has splintered into pieces. The top 10% of earners now make more than 13 times the income of the bottom 10%, a level of inequality that rivals developing nations, not the richest country on earth. This imbalance is not abstract. It has real, measurable consequences on every attempt to climb upward. When the cost of living rises faster than earnings, mobility becomes mathematically impossible for the bottom half of the population. While the wealthiest households saw asset values surge during the last decade, stock gains, real estate appreciation, corporate bonuses, ordinary families faced rising rents, higher healthcare bills, and an economy where wage growth lagged consistently behind inflation. The pandemic accelerated this divide. Corporations with deep cash reserves responded to labor shortages by offering retention bonuses and increasing pay for high-skill roles. Meanwhile, small businesses and public sector employers lacked the resources to match these adjustments. As a result, the inflationary wave strengthened the financial positions of upper-income groups while simultaneously eroding the purchasing power of everyone else. The Gini Index, a measure of inequality, rose 1.2% in a single year, reversing a decade of slow improvements. This isn't simply a story of the rich rising faster. It's a story of economic floors collapsing beneath millions. When entry-level workers earn wages that fail to cover basic expenses, savings become unattainable. And without savings, even minor shocks trigger financial descent, not ascent. The ladder isn't broken because people refuse to climb. It's broken because the rungs are now spaced too far apart to reach. This inequality also shapes opportunity access. The cost of education, home ownership, transportation, and healthcare creates barriers that disproportionately restrict lower-income Americans. These barriers compound over time, ensuring that wealth concentrates upward while insecurity spreads outward. The growing imbalance now connects directly to the next breaking point: the collapse of the living wage. Because when the gap between what life costs and what work pays becomes too wide, inequality doesn't just expand, it transforms into a permanent structural trap that locks millions into economic stagnation. The economic foundation of the United States is cracking because the price of survival has detached completely from what employers are willing to pay. The collapse of the living wage is not theoretical. It is visible in every bill, every paycheck, and every month where millions of Americans fall short despite working full-time. According to MIT's calculations, a basic living wage for a family of 4 now requires $24.16 per hour per adult, yet the federal minimum wage remains stuck at $7.25, unchanged for more than a decade. The gap is not small, it is catastrophic. Even jobs paying $15 an hour, once considered decent entry-level wages, no longer cover modern expenses. Housing alone consumes half of many workers' income. Healthcare deductibles reach into the thousands. Childcare rivals the cost of monthly rent. Transportation, utilities, and groceries rise faster every year. When essential costs outpace earnings this aggressively, financial stability becomes mathematically impossible. Workers aren't failing to budget. The economy is failing to provide the income required to make budgeting meaningful. This wage imbalance becomes even harsher when accounting for inflation. Over the past few years, the price of food, transportation, and energy climbed far faster than wage growth, leaving workers poorer in real terms despite nominal raises. When the real value of a paycheck collapses, families lose the ability to build savings, cover emergencies, or plan for the future. The result is a permanent state of financial tension where survival requires constant trade-offs. The collapse also exposes a deeper structural flaw. The economy increasingly relies on low-wage labor while withholding the compensation needed to sustain that labor. Millions work long hours in physically demanding roles yet remain unable to cover basic household needs. This disconnect fuels turnover, stress, and burnout. It also pushes families toward credit dependence, feeding directly into the rising national $1 trillion credit card burden as workers swipe their way through unavoidable shortages. The erosion of living wages now feeds directly into the breakdown of America's support systems. Because when work itself cannot guarantee stability, families turn to safety nets that were never designed for today's costs, creating the next fault line in the country's economic crisis. As wages collapse and costs surge, millions seek support from systems that were never built for a modern economy. America's safety net was designed in a different century, calibrated for a world where rent was cheap, groceries were affordable, and healthcare did not require thousands of dollars just to walk through a hospital door. Today, those same programs operate with outdated formulas, forcing families to navigate assistance structures that barely acknowledge 21st century living expenses. Monthly cash support for low-income households is often shockingly small. In many states, a family of 7 receives roughly $250 in welfare, an amount erased instantly by a single grocery trip in an age where basic food staples cost double what they did just a few years ago. SNAP benefits fail to match actual food inflation, leaving millions short every month. Medicaid eligibility cliffs create a cruel paradox. Earning even a small raise can trigger the immediate loss of healthcare coverage, punishing households for attempting to improve their situation. These benefit cliffs are one of the most damaging flaws in the safety net. A parent who secures a modest wage increase may instantly lose childcare assistance, forcing them to choose between accepting better pay or retaining support that keeps their children fed, housed, and medically protected. Instead of serving as a bridge out of hardship, many programs function like traps, pushing families to remain below income thresholds to avoid catastrophic benefit losses. This outdated infrastructure becomes even more inadequate when measured against skyrocketing living costs. When childcare averages $10,000 to $15,000 a year, when rent surpasses 40% of income, and when healthcare deductibles reach $3,000 to $5,000, a safety net built on mid-1960s assumptions collapses under the weight of modern reality. It simply cannot keep pace with the financial pressures facing today's households. These structural flaws now connect directly to the next crisis: how America measures poverty itself. Because the very metrics used to determine eligibility for support, metrics rooted in a world that no longer exists, allow millions of struggling families to slip through the cracks, uncounted and unseen in official data. The result is a system misaligned with the economy it is supposed to protect people from. The crisis within the safety net leads directly to an equally serious flaw. The way America measures poverty is fundamentally broken. The thresholds used to decide who qualifies for assistance come from formulas created in the mid-1960s, based on the cost of a minimal diet times 3. That calculation made sense in an era when housing, childcare, and healthcare were a small portion of household budgets. Today, those categories dominate monthly expenses, yet the official measure still relies on a framework frozen in time. This outdated formula produces an illusion of progress. It counts only pre-tax income, ignoring the reality of what families actually take home after payroll deductions, healthcare premiums, and rising living costs. It also assumes identical spending patterns across all households, failing to account for modern family structures, higher childcare burdens, or situations where multiple generations live under one roof. Even more damaging, it uses uniform national thresholds, overlooking extreme geographic differences where living in Mississippi and living in California require vastly different incomes for basic survival. The Supplemental Poverty Measure, SPM, introduced in 2011, attempted to correct some of these issues. It adjusts for housing costs, includes government assistance, and captures spending on essentials such as food, utilities, and clothing. While this makes it more realistic, it still falls short. SPM does not fully incorporate modern childcare costs, medical insurance gaps, or state-level food inflation disparities, meaning millions who are economically insecure remain invisible in federal data. This measurement failure has real consequences. Eligibility for crucial programs, SNAP, housing assistance, childcare subsidies, Medicaid, depends on classifications that undercount struggling households. Policymakers rely on these numbers to allocate billions of dollars, meaning flawed metrics lead to flawed decisions. Without accurate data, states and cities misjudge the scale of economic hardship, leaving families unsupported while leaders falsely assume progress has been made. The poverty measurement crisis directly shapes the next stage of America's economic breakdown, the power of policy itself. Because when the tools used to identify need are outdated, even the best-designed interventions cannot reach everyone who requires them, proving that the fight against poverty is not just about economics, but about fixing the systems used to understand it in the first place. The failure to measure poverty accurately leads directly to a crucial truth. Policy is the only proven tool capable of lifting millions out of hardship. When governments intervene with targeted support, the effects are immediate and measurable. During the pandemic, federal programs, expanded tax credits, enhanced unemployment benefits, emergency stimulus, lifted 45.4 million Americans out of poverty under the Supplemental Poverty Measure. It was one of the fastest and largest reductions in economic hardship in modern U.S. history, achieved not through market forces or wage growth, but through direct policy action. Another undeniable example is the transformation of elderly poverty. Social Security and Medicare reduced senior poverty from levels that would hover near 40% down to about 10% today. Without those programs, nearly 4 out of every 10 older Americans would fall below the poverty threshold. That is the clearest evidence that poverty is not an unchangeable condition. It moves dramatically when policy changes. Yet despite these successes, most anti-poverty measures remain temporary, limited, or tied to political cycles. The expanded child tax credit of 2021, which cut child poverty nearly in half, expired after a single year. Unemployment support reverted to pre-pandemic levels despite ongoing economic instability. Housing programs remain underfunded, even as rents consume unprecedented portions of household income. When assistance is removed, poverty returns just as quickly as it was reduced. The country repeatedly moves between crisis relief and crisis relapse because policy is deployed reactively rather than structurally. The tools exist, the consistency does not. This inconsistency pushes the nation toward the next breaking point, the psychological and behavioral impact of financial instability. Because when policy lifts millions only to pull support away again, families are left emotionally exhausted, financially exposed, and more vulnerable to the pressures that shape spending habits and mental health. Proving that the fight against poverty is not only economic, but deeply human. As economic pressure intensifies and policy support rises and falls unpredictably, millions turn to coping behaviors that quietly reshape their financial lives. This is where poverty stops being only a math problem and becomes a psychological trap. Even households earning $100,000 or more increasingly live paycheck to paycheck, not because of luxury excess, but because emotional spending, lifestyle inflation, and scarcity-based decision-making take root under constant stress. Lifestyle creep begins subtly. A small raise or promotion creates a brief sense of relief, and that relief often translates into small upgrades. Dining out more often, subscription stacking, entertainment splurges, or higher-cost conveniences. These upgrades feel harmless at first, but once they become routine, reversing them is emotionally difficult. What was once an occasional treat becomes an expectation, creating a cycle where rising income is consumed instantly by rising expenses. For others, emotional spending becomes a coping mechanism for chronic financial anxiety. When wages fail to cover basic necessities and stress accumulates, small purchases provide temporary dopamine, a psychological escape from constant pressure. But emotional relief purchases accumulate into revolving balances on credit cards with interest rates over 22%, feeding the same debt system that keeps families financially trapped. Scarcity thinking is even more damaging. When people grow up or live long periods in financial insecurity, the fear of not enough shapes every decision. Some overspend to experience short-lived joy. Others hoard money excessively, depriving themselves of essential needs. Both reactions come from the same mental environment: long-term financial uncertainty that erodes rational planning. These behavioral patterns reveal a deeper truth. Financial instability is not only about low income. It rewires how people think, plan, save, and spend. Constant strain pushes individuals into decisions that feel good in the moment but weaken long-term stability, reinforcing the cycle of financial fragility. This psychological trap now feeds directly into the next major collapse: the rising debt storm. Because when stress, inflation, stagnant wages, and emotional pressures collide, Americans increasingly turn to the only tool left available to them: high-interest credit, setting the stage for a national financial crisis that is already unfolding. America is entering a debt spiral unlike anything seen in modern history. With wages lagging behind the cost of survival and financial stress reshaping behavior, households are relying on credit not as a luxury, but as a lifeline. This is how the country reached $1 trillion in credit card balances, the highest level ever recorded. The number itself is shocking, but the conditions behind it are far more alarming. Americans are using high-interest debt to pay for basic needs, not discretionary wants. Credit card interest rates now exceed 22% on average, while retail cards climb beyond 29%, with some hitting 33%. Rates once associated only with subprime borrowers. At these levels, even a modest $2,000 balance can balloon into thousands more in accumulated interest, trapping households in long-term repayment cycles they cannot escape. As incomes fall short of essential expenses, credit becomes the default solution, turning short-term gaps into permanent burdens. The scale of this expansion is massive. More than 70 million new credit card accounts have opened since 2019, reflecting the growing number of people forced to bridge financial shortfalls with borrowed money. For many families, debt repayment now competes directly with housing, transportation, and food, essential categories that cannot be reduced. This conflict accelerates delinquency rates, which are rising across major banks and retail lenders, early indicators of widespread financial strain. The exhaustion of pandemic savings has added fuel to this storm. The temporary cushion that once softened the blow of inflation, job instability, and rising costs is gone. Without that buffer, households are vulnerable to even the smallest financial shock. And with interest rates at historic highs, the cost of borrowing becomes heavier every month. This rapidly building debt storm leads directly to the next national pressure point: the consumer cliff. Because when a population already stretched thin continues to pile on high-interest balances, the question is no longer whether financial pain will spread, but how soon it will transform into a full-scale economic crisis that reshapes the future of American stability. For months, analysts repeated the same phrase: the American consumer is resilient. But resilience has an expiration date. When wages stagnate, when savings evaporate, when credit becomes the primary survival tool, resilience mutates into quiet collapse. America is now standing on that cliff edge. Household spending is still high, not because families are thriving, but because they are borrowing aggressively to maintain basic living standards. The holiday season is the clearest indicator. Shoppers prepared to spend nearly $900 each, despite rising delinquencies, rising balances, and rising interest rates. Historically, credit card debt falls after the holidays as households pay down their bills. But this year, the debt never dropped. It stayed elevated, signaling that repayment capacity has been exhausted. Major retailers are sounding alarms. Macy's and Nordstrom both reported a surge in missed credit card payments, a warning that consumers are no longer able to keep pace with their obligations. These early delinquencies often precede broader financial distress, spreading from retail cards to mainstream credit, auto loans, and eventually housing. The financial structure of the average household is now mathematically unsustainable. Consider the burden: a $6,000 average credit card balance, a $400 to $600 student loan payment, soaring rents, insurance premiums climbing across every category, and the lingering shock of inflation in groceries, utilities, and transportation. When essentials exceed income, collapse is no longer theoretical. It becomes unavoidable. The return of student loan payments is pushing millions even closer to the edge. Combined with high interest rates, families have fewer tools left to stabilize themselves. The slightest emergency, a medical bill, a car repair, a rent increase, can trigger a chain reaction that ends in default, eviction, or long-term debt entrapment. This consumer cliff is not just a household crisis, it is an economic warning. When the spending power of the middle and lower classes breaks, the broader economy follows. America is approaching a moment where the consumer, the engine of 70% of the US economy, can no longer sustain the illusion of strength. The fall has already begun. The impact is what comes next.